And now, to welcome you, representing premier sponsor U.S. Bank, Amy Schubert, Senior Vice President and Wisconsin Market Leader.
Good afternoon, Milwaukee, and welcome to the 2025 Secure Futures Investment Conference. As mentioned, I am Amy Schubert, Senior Vice President and U.S. Bank Private Wealth Management Market Leader for the state of Wisconsin. I'm also grateful to be a member of the Secure Futures Marketing Committee. I'm honored to be here representing my colleagues at U.S. Bank as we continue our long-standing premier partnership with Secure Futures. U.S. Bank has over a 160-year history here in Milwaukee, and we are dedicated to our state. We invest in Secure Futures as a part of our community support because we believe that financial literacy shapes the future of Wisconsin and will help keep us on the map in the most positive of ways. U.S. Bank employs over 5,000 people in our beloved state of Wisconsin, and we serve nearly 700,000 clients across wealth management and retail, commercial, business, corporate, and mortgage banking. We're the largest deposit holder in the state and the largest Midwest bank. We are Wisconsin proud. On a personal note, my engagement with Secure Futures began 17 years ago when I had the opportunity to work with a visionary leader named Joe Schlitt and a dynamic, passionate CEO named Brenda Campbell. They had a vision to create an investment conference that would allow Milwaukee and the fine professionals that we have here in our city to shine. Inspirationally, they wanted to build the Ira Zone of the Midwest. The three of us brainstormed to create the framework of what a conference heavily supported in unity by Milwaukee's best and brightest financial professionals could look like. And Joe and Brenda and many, many of you brought that vision to life. As I, for the first time, look out at all of you coming together to enjoy what Secure Futures has built over the past 17 years, I'm incredibly humbled. When Wisconsin stands together for the benefit of our youth, it's incredible what we can accomplish and can sustain for nearly 2 decades of excellence. We are changing our future together. Through Money Path, Money Sense, and Money Coach, Secure Futures provides young adults with essential life skills that extend to success far beyond personal finance. The intentionality of determining what is a want and what is a need. The rigor, discipline, and commitment required to establish a budget and stick to it. The understanding of why and how to set goals and how to develop a plan to get there, adjusting with the changes life brings us. When we pass these skills to the next generation, when we share our time, expertise, and resources with Secure Futures, we ensure that Milwaukee will continue to flourish, grow and build our community support systems, change family trees, and retain our space as our own Wisconsin Mecca of financial services. Thank you for committing your time and attention today to this important work. With that, I'm pleased to introduce Max Mann, Managing Director and Portfolio Manager of Specialized Asset Management at Baird and Chairperson of the Secure Futures Board of Directors. Enjoy the conference.
Welcome, everyone. Thank you for attending the 17th Annual Secure Futures Investment Conference. Thank you, Amy, for the introduction. I am proud to serve as a representative of Baird, as the chair of Secure Futures Board of Directors, as well as the co-chair of the Investment Conference Planning Committee and a member of our Governance Committee. This is honestly one of my favorite days of the year, and standing up here in front of you gets my heart pumping. This is awesome. It's great to see everyone. Many of you have been here multiple times. Welcome back. Thank you for telling your friends. We have a lot of first-timers in the audience, And for the newbies, you're in for a treat, let me tell you. Here is my conference pitch, 3 bullet points. Number 1, you're going to hear incredible investment content from our world-class speakers. Number 2, you're going to learn about and have the opportunity to support an incredible organization that is impacting the financial capability of teens throughout our communities. And 3, look around the room. There's over 500 attendees here from the Milwaukee community. You're going to have a chance to network and reconnect afterwards at the networking reception that I hope everyone will stick around for. So it's going to be a good day. It's going to be a really good day. Let's jump into it. I'll start with housekeeping. So number 1, please silence your phones. Number 2, we are not taking breaks. You're welcome to take a break, but we're not going to. There are refreshments on both sides. The restrooms are right out the back doors to the right. I'd like to take the opportunity to thank our incredible speakers today for their time. Thank you for coming out. I'd also like to take a couple minutes to thank our sponsors. This event would not be possible if it wasn't for the generosity of our sponsors. I'll ask you to hold your applause until I get to the end. Our generous premier sponsor, U.S. Bank. U.S. Bank has been a sponsor for more than a decade, and we're honored to again have their generosity and support as the premier sponsor. The networking event sponsor, Godfrey & Kahn. G&K has been involved since day 1. Please join us for complimentary food and beverage, once again provided by G&K, at the reception following the conference. Our speaker sponsors, Artisan Partners, Allspring, Baird, Offutt Capital. Now our presenting sponsors. Our presenting sponsors provide an impressive and generous amount of support. Alpha Investment Consulting Group, the Baird Center, Heartland Funds, Morgan Stanley, Tim Carr Wealth Advisor, Northwestern Mutual, and the Preby Family Foundation. We're honored to have the support of our supporting sponsors, including Associated Bank, BMO, the CFA Society of Milwaukee, Cohn & Co., First Weber Foundation, and Pritzker. And we thank our generous program, community, and mission sponsors you'll find listed in the program. Please join me in applauding all the generous sponsors for their support. All right, now let's get started. It's my honor to introduce the MC for this afternoon's event, the one, the only, Joe Schlitt. Joe is the Director of Client Special Services at Godfrey & Kahn, a past board chair of Secure Futures. Joe developed this conference in 2009 and has become a major and critical funding source for this organization. Please put your hands together for a true champion of Secure Futures, Joe Schlitt.
You can let yourself groove a little bit, that's okay. Well, thanks everybody, thanks Max, and good afternoon to all of you. It's great to see so many old friends and some new faces in the audience today. You're in for a special afternoon. It's a great reminder, and I appreciate the recognition that people have given me, but this conference doesn't happen without a lot of people's hard work to get to this point. So for all those people who are part of the conference planning committee, would you please stand and get recognized by the audience for the work that you did in making this event come together? Thank you all. Brenda asked me to share with you all why I continue to stay involved. For me, it comes down to being part of an organization that's able to impact so many young people's lives at precisely the right time for them. I believe in the power of good financial decision making, and when that is compounded over time, the results can be spectacular. I wanted to be part of that type of organization, and that's exactly what you get with Secure Futures. Before we get started, I'd like to take just a minute for a special thank you. Last year, you were all very kind to recognize me with the Champion Award, and it meant a lot. If you were here, you knew that it came as a complete surprise to me, and I didn't have a chance for any prepared remarks, much less the chance to properly thank people as I would like to who in the audience. But today, I'd like to do 2 proper thank yous to 2 wonderful women. First is my mom. Obviously, without her, I'm not here. My mom's here in the audience. And the second is my wife, Katie, who's in the audience today as well. Katie stuck with me. I made a 2-year commitment to Secure Futures, and that's turned into a 17-year, 18-year run. She's seen all the stress, the nerves, and the excitement I've experienced with this great organization. She's been my rock through all of it. Katie, that award was as much for me as it was for you, so thank you, I love you. And you know she's a great wife because she comes up the escalator and hands me a Snickers bar because she knows I probably didn't eat enough prior to this just to keep me fed, so that's awesome. I'd also like to thank our friends at Alpha Investment Consulting for tracking the performance of last year's investment ideas. Bob Bukowski shared with me that had a person equally weighted invested in the ideas shared last year, their performance through yesterday would have been up 31.39% versus the S&P up 10.23% over that same period. Not bad. No pressure, speakers. Please remember that past performance doesn't guarantee future performance. However, if you would like a recap of the investment ideas shared today, fill out the green survey. So it looks like this. It's in your program. If you fill out the green survey, put in your email address. We'll make sure to get those ideas out to you as soon as possible. So let's cover what you're going to experience today. We're going to start off with Nick Bonsack to share his economic perspective. Then we're going to transition to Janet Rilling from Allspring, followed by Evan Scorpin from Lead Edge Capital for their most compelling investment ideas. So a lot of content in a very short period of time. Stay tuned. Then we're going to hear from Brenda Campbell with an update and help you show how you might be able to support Secure Futures after we hear from our student speaker, Ebony Dable. And then we're going to be following that up with Lloyd Levine with our champion winner presentation. And then I'm lucky enough to close out with our keynote interview with Bill Naskovitz, followed by our networking reception. So we should wrap up right around 4 o'clock. And as Max said, we don't take breaks. We're just going to keep it rolling. It might be the fastest 2.5 hours you've spent in a long period of time. So let's buckle up and let's get started. So our first speaker today is Nick Bonsack. Nick is the co-founder of Strategis and serves as the president of the firm's institutional broker-dealer, Strategas Securities. He's responsible for the firm's institutional security business with enterprise and strategic responsibility for macro research, sales and trading, and capital markets. And I could go on, but we only have so much time. So Nick, would you please join us up on the stage for our economic perspective? Thanks.
Thank you. So that's the Beastie Boys. So anyone who's a child of the 80s or maybe the early 90s would know the Beasties. The name of that song is Sabotage, which is, I think, a little bit of what might be happening in the economy, or at least potentially was attempted in the last 6 weeks. The interesting thing about that song is that it has no chorus, which is it's just one voice. And you could say maybe it comes out in tweets or truth bombs. But that's a little bit of what we've been dealing with for the last 6 weeks. And so the folks asked me to bring some slides to the party, and we put them together about a week ago. There's 54 of them. We were only going to go through 10, but 44 of them are no longer relevant. So we'll stick with a different 10. So somehow we'll get to this. So this is what we're watching. At our firm, at Strategas, and I'm very, very, very pleased to be here. I think that the mission of Secure Futures is, frankly, should be replicated nationwide. Financial literacy ultimately is something that we hear a lot about in our practice. And we generally start with one mantra, which is let's keep it simple and let's be focused on the things that really matter. So this is a list of what we're watching, and frankly, each of these could take 20 minutes and then some, but we'll rip through them in short order here. So the last 6 weeks has really been all about number one, which is Trump, it's tariffs, it's taxes. I was with a colleague last week, and somebody said, we're all terrified, and something compelled me to ask how we were spelling that. But this is ultimately what we're dealing with, and I think, truth be told, if I were to look at the second quarter, I would draw no inference from it whatsoever. For 6 weeks, we had horrible news. Stock market was down. Everyone was feeling sort of horrible about the conditions. And then in the last couple of days in particular, but in the last couple of weeks for sure, we've seen ourselves sort of rally straight out of that. But you're going to get a lot of pull forward in economic activity in the second quarter. You're also going to get what we describe as a CFO appliance sale, everything but the kitchen sink. They're going to lower all the expectations you possibly can because everybody else is doing it. So ultimately, we have a very small window. All right? What are policymakers going to do about it? We've raised the stakes. We've raised the stakes such that, between Memorial Day and Independence Day, we're looking for either the Fed to do something or we're looking for the Congress to get taxes over the threshold. These are very difficult, these are monumental sorts of accomplishments, less so on the lowering of the policy rate, certainly, but with respect to taxes, these are really big undertakings. It's going to be very difficult. It's a very small window. So what happens in the 2Q stays in the 2Q is sort of how we should think about it. And we need to sort of look beyond that. We need to look out into the second half in 2026 by our lights. And so what are the things that are important? Growth is important. We'll jump to number 5. What are the organic drivers of growth that are going to sustain the economy, help propel it, help it to reaccelerate as we move out into next year? We'll come back to number 3. We're looking at inflation. Look at the volatility of inflation expectations. So these are the things that we ultimately think are most important as we jump in to the fray. One of the most frequently asked questions that we get when we travel around is really about the psychology of Trump. All right? For some reason, they think we have some insight. I'm not sure that we do. But at the end of the day, we sort of think he's really just trying to solve for one thing and one thing only. And I think this chart actually articulates it better than almost any other thing. This is total factor productivity. This is going to measure, as you all know, the improvements, the efficiency, I don't know if you've heard any of those words recently, in government, in the economy. And you can see that in the early 1970s, it sort of bent down and the slope softened. And what we've really engendered in this country since that time was an overinvestment in financial things and a less investment in real things. And Trump is a real estate guy from New York. Love him or leave him. I'm not here to offend anyone's political sensibilities. He's the guy in the chair. He's trying to fix that, ultimately. In his mind, that's what he's trying to fix. So he wants to bend this curve back upward by extracting some efficiency from the economy, by building things, bringing things back here, sort of, as he would say, make America great again. Whether you subscribe to that or not, I would watch this chart more than almost any other for some sort of a slightly longer-term inference as to whether or not the president and his administration and his policies are being successful. All right, 4.5 minutes through, we got a lot to go. So we're going to jump down here to taxes. No hyperbole here. This will be the most important year for taxes since the advent of the personal income tax in 1913. If we do nothing, we have a $400 billion tax cliff that will come our way on New Year's Day. We have a $4 trillion tax cliff over the extended budget window, all of which you know well. The president is hard set on trying to extend that. But if we don't, we are going to have some very real economic repercussions as we move into 2026. So that is the order of the day for the Congress. Bar anything else with respect to tariffs and to trade, the Congress really has to get the tax bill passed. And then, of course, the president campaigned, as most politicians do, on giving a few more goodies away. And, they're hard set on trying to get the no taxes for tips and some of these other tax-related goodies into this package as well. And the speaker, I don't envy him in the least. He's got a very tall order. So when we think that, hey, gosh, the market was limit up yesterday or everything's sort of looking good, we want to take that with a grain of salt. And I think as we move ourselves through the second quarter, we want to pay particular attention to what's going on with the tax negotiations. Mercifully, at least this is my opinion, mercifully, we've seen some of the folks that were out front for the administration on trade. We've sort of seen them move back to the office. I think they're in the Eisenhower Executive Office building now. And we've seen some real folks who come from the financial industry, in Treasury in particular, leading some of the negotiations as it relates to the details on trade and then specifically on taxes. But this is a biggie. This is a big year. If there was one item on here that I would highlight for you, I think it's the 4th bullet down. It's the state and local tax deduction. A lot of folks are so focused on the SALT, particularly I live in New England, where we very high tax states. I know you're on the list yourselves, but suffice it to say, we got a lot of members of Congress, Democrat and Republican alike, who would like to see the SALT cap raised. And they're going to do a solid for most individuals because that's who goes to the polls. But mind you this, for all the companies that are changing where they're headquartered, if they have physical plant in all those other states that they've left behind, even if the C-suite can move to Texas or to Colorado or to Tennessee, they have a corporate SALT tax problem. And that pays for a lot of bills at the individual level. So look for some of these sort of finer kernels as we talk about taxes to sort of see just how things are going. So here's a great example of a chart that is already out of date. This is our recession checklist. As I mentioned at the top, we like to keep things as simple as possible. My partner, Don Rissmiller, has this list of items. And as of last Thursday or Wednesday, when we sent the slides over, we had 4 items checked off. Our recession odds were 45% until yesterday, and now they're 35%. I don't want to be too cute by half. Effectively, it was not the base case, but there was certainly there's an elevated probability of recession. We had 4 items checked off, so a 4 handle at the front seemed appropriate. And when you think about those 40% recession odds, we were sort of evenly split between a slowdown in economic activity, with which is accompanied a financial event, at which point you're going to have 100% recession odds, sort of all the jig is up, or a slowdown in economic activity where we're able to avoid a financial event, and we've been able to do so. And so you'll notice the second to last item here on the list is BAA spreads. They were off the tights. They widened through the levels of last August, where we had a little bit of a growth scare, and of course they've narrowed down more recently. So we've unchecked that. We now have 3 out of the 8 items still checked off on the list. At the moment, when we think about the economy, and I apologize for this stand here, I think as folks are looking through some glass, but when we think about the economy, there's really 2 major things we want to focus on. One is growth and one is inflation. And for 18 months, I'd say prior to March and April, when we started to wind up for the tariffs, we were more worried about inflation. And it seems somewhat counterintuitive that as we raise tariffs globally, we're less worried about inflation, right? This is a wonderful study that our team has done where it effectively looks at the fact that in most developed economies, you've got about a 90% chance of inflation playing out in multiple waves. And the first wave is cured by math, right? Which is in the 13th month, if you just move sideways for a long enough period of time, you'll get the year-over-year rate of change to fall. But we never quite take the medicine necessary, and so we ultimately evidence a second wave of inflation, and that was our great concern. We started to see some subtle building in some of the more timely components of inflation. But the impact of the change in the trade items ultimately leads us to be more concerned about growth. So we'll be very focused in the 3rd quarter and the 4th quarter, again, given those elevated recession odds, even if they are a 1 in 3 probability. The issue is, unless you see the follow-through, unless you see capital expenditure, unless you see those organic drivers of growth manifest, you could end up with a bit of a stagflation problem in 2026. Now, we don't need to rip out the history books to compare ourselves to the 70s. That's not what I'm making the case for. But I think we just want to keep on the horizon, we want to keep in our field of vision this idea that we could have softer growth than is expected and slightly higher inflation than is expected. And this is sort of the past, unfortunately, being prologue in that regard. And how it hits home, ultimately, is that the prices of the things that people have continued to outpace the increase in their wages, right? You can draw all sorts of political inference from this chart, but that is the problem that they are trying to solve for, right? They've got to bring down the basket of goods and services, ultimately, to the extent to which they are not being, or they stop exceeding the pace of wage growth. So this is another very timely chart that we would want to keep our eyes on. So let's focus down here and give you two things to keep track of. The Fed is standing pat, right? Chair Powell is not going to go along with the ECB. They're not going to go along with the Bank of England and cut interest rates. He's waiting on the hard data. I don't entirely disagree with that. That's tantamount to saying, hey, what happens in 2Q stays in 2Q. Give me some signposts for what's going to go on over the horizon. But there's some other indicators here that you might jot down and pull up on Terminal from time to time. Small business uncertainty. This can't be high and the economy do well. So you've got to get the uncertainty index among small businesses to come down. The other one, which has some lagged effect because it suggests, hey, we're really in trouble given the way that bankruptcy laws are written in this country, is when you see Chapter 11 bankruptcy filings moving higher, right? There's probably, 3,500, 4,000 publicly traded securities any one of us would put in our portfolio on any given day, given the right set of conditions. How many small businesses do you think there are in the United States? Close, 19 million. Right? There's 19 million small businesses in this country, and so to the extent to which you see a rising number of them file for bankruptcy, that is not indicative of a super strong economy. We want to pay particular attention to corporate profits, right? 2Q, as I said earlier, we're going to throw everything at it, everything but the kitchen sink. Now, the first quarter corporate profits are going to come in close to 15% year-over-year rate of change. That's pretty darn good, but it all existed prior, right, to the change in the rules at the beginning of April. Moreover, you could argue that there was some pull forward in economic activity into the first quarter, which may be pumping those numbers up. 2Q is a broken play. What happens as we look out onto the horizon? What happens when we look out into the second half of the year or the beginning of 2026? This chart doesn't contemplate 2026, but what's interesting is that when Wall Street makes an estimate for a period of time that's 12 months in the future, on average, that estimate, that pebble you've thrown out there, 12 months in the future, on average, that will be 10.2% lower by the time you go pick it up 12 months from now. We saw almost no erosion in the 2025 line until the last 4 weeks, at which point we've seen the entire pocket collapse and we've seen 2025 estimates roll over. We need to be paying attention to this. Ultimately, a sideways tick, even an uptick, would be welcomed, would certainly be a welcome signpost. Let's talk a little bit about valuation. Still a problem, right? So I was asked a question earlier today by one of the folks here, said, gosh, are we going to have sort of more of a risk-on profile? Is it going to be animal spirits as we move through this? And it may be. Certainly there's an opportunity set that exists for U.S. equities to rise and do fairly well. The issue is I'm not sure you're going to get the same leadership profile. In fact, it would be almost it would be rare to see the same leadership profile coming out of such a degradation in stock prices that you saw on the way in. And so I would look for a new type of leadership to emerge, but I want to stay away from companies that are very excessively priced. So we can see this spread the world over, right? We've got U.S. shares continue to be somewhat higher priced than international shares. And the thing of it is, when you completely upend what's happening in global trade, right, you are, whether you like it or not, you are actually creating an incentive for domestic investment outside the United States. So from the vantage point of other countries. Now, it's very important for us to continue to watch what's going on from other countries' perspective with respect to their own national defense. That's a mouthful. I don't know if I can do it again. But suffice it to say, most defense growth comes from defense tech investment, and most growth tech innovation comes out of the Defense Department, particularly for smaller countries like than ourselves. And so if you want to force our NATO allies to spend more on the national defense, maybe you get a little bit of overflow and they buy more planes and bombs and things from you. But what's really you're engendering is a domestic tech investment. So you're actually shifting what has been traditionally a value segment into a growth segment over time. That is I would describe that as a secular conclusion, but could it become structural? So our job at Strategas is, we try to identify things in the moment that you want to pay attention to. I also want to sort of look at things out on the horizon that we want to pay attention to. You might have a style shift that's playing out in international equity. We'll stay on valuation for a moment. I've only got 4.5 of them left, but this is, some of you might be familiar with that old toy. They basically found themselves in like the toy box in kindergarten classrooms. There was an abacus, and the kids would just mess with the beads. And I say this every time I speak with an audience. You used to be able to do math on them, but it sort of this chart to me is reminiscent of all the beads being on one side or to one extreme. And so if you look at the various and sundry valuation measures here, they are all at their extreme. 2 have come off the boil. Next 12 month, which is the second to last, and trailing 12-month PE ratios, which is the fourth from the bottom. They've come off a little bit, but the next 12-month PE is still in its 88th percentile, right? So the market is still inherently expensive, except by one measure, which is, I think, the most bullish thing I can share with you today. I don't know, we've got the circle kind of going around a different orbit there, but it should be around the little tooth, and that's price to free cash flow. And so when we think about cash flow, free cash flow gives companies total optionality. But if you upend their supply chains, they may have a less efficient allocation of that capital. There's only 6 things a company can do with their money, right? They can buy another company. They can pay labor more, pay more labor or pay labor more. Those have different multiplier effects. They can retire their debt. They can pay a dividend, right? Ultimately, if they take none of those decisions, they have retained earnings, total optionality. So if the cost of capital remains high, that's the type of area we want to focus on. So at our shop, macro, one of the chief pushbacks about macro is, well, how do I actually implement that into my portfolio? We try to come up with themes. Ultimately, where we're finding thematic momentum is where the opportunity set ultimately in our estimation resides. We see 4 themes right now that we think have an appropriate and lasting amount of thematic momentum. We talk about cash flow aristocrats, artificial intelligence, you can read them, industrial power renaissance, and ultimately deglobalization. So here's here's trailing 12-month free cash flow. Those are the 7 things that companies can do. They can acquire, they can engage in CapEx, as I mentioned, labor, share buybacks, they retire debt, pay a dividend. But what's happening is companies aren't really doing any of that. We saw a little bit of it in the Mag 7 in terms of, hey, you're spending $100 billion, I could spend $200 billion on some AI-related CapEx. But ultimately speaking, companies are in great shape. So as a colleague mentioned to me just before I came on stage, be bullish, he said, MB, be bullish. So this is about as bullish as we can get. If you get a lot of free cash flow amongst U.S. corporate operators, they have enough to absorb a lot of the supply chain dislocation that we're putting the economy through. This is the artificial intelligence slide. The line that stands out is the amount of investment in CapEx that we made building, where we basically built data centers over the last number of years. Right? You're starting to see this roll over. Our anticipation is that this will continue to roll over. AI is shifting from its first generation, which by the way was a 40-year story that we just sort of dropped into the economy in 2023 in terms of machine learning, rebranded AI, bang, next thing you know, huge momentum shift in the market. But it's evolving. It's evolving from the Mag 7 where we train models and build compute capacity into a more agentic application where the solution set is going to be productivity growth, it's going to be drawing inference, it's going to be drawing context. That's a whole new and very investable and very exciting phase of artificial intelligence. I pay a lot of attention to that as we move down the road. The industrial power renaissance, to me, is probably, if you're looking for a theme that's got a lot of momentum in the short term, to which almost every member of Congress agrees, it's the industrial power renaissance. Nobody wants to be the district where the lights go out. So we're going to have a total energy plan. That's not a political statement. They're literally going to make investments in all these different areas. But even if you turned AI off, just look at all these other things that are so dependent upon the industrial power renaissance. To me, this is a very powerful theme. And the last one, I'll leave you with this. There's 9 seconds left. We did a decent job. Is on deglobalization. And unfortunately or not, this is probably going to define the next 10 years of our investing lives. Each of these items, from trade to natural resource procurement, defense alliances, as I mentioned, and populism, are each going to sort of grab mind share on any given day of the week. But ultimately, if you can find the kernels within them, we think there's a lot of thematic momentum and an awful lot of opportunity. So that was the quick 20. Our economic forecast can be summed up like this. We got a lot of opportunity ahead of us. It's just going to be more difficult, won't be as flows driven. Have a wonderful conference. I appreciate you for inviting me. Thank you.
Thank you.
Yeah.
Unfortunately, Nick has to run, so he's not going to be able to stay with us. So again, thank you, Nick. Really, really appreciate it. That was terrific. I'm super excited about our next speaker. Janet Rilling has the difficult issue of making bonds cool, but I think Janet's going to be able to pull it off. And the reality is there's been a lot going on in the bond market recently that's going to make it really interesting. Janet is a senior portfolio manager and the head of Plus Fixed Income at Allspring Global Investments. In this capacity, she has oversight and portfolio management responsibilities for separate accounts, mutual funds, and commingled vehicles across a range of strategies. Please help me welcome Janet Rilling.
Well, good afternoon. That's a high bar. Bonds are cool. I know we live in interesting times when they want to hear from the bond person, so I think that's the first takeaway from today's session. So I thought I'd begin by talking a little bit about Allspring because not everyone may know about our firm. We're a $600 billion asset manager, and we're located in 20 offices worldwide. Our largest office happens to be here in Milwaukee, and we recently moved to a new location. So we are now residents of the 3rd Ward here in Milwaukee and are very excited about our new location. We manage active strategies, so fixed income, equity, multi-asset solutions, a range of strategies to a variety of client types. And I think what I'm most proud of our firm is our investment results. So we have 128 composites that have 10-year track records, and of those, 88% have exceeded their benchmark. So let's move into it. Let's start talking about markets. Clearly, markets have been moving. There's been a lot going on, and I think we could sit and debate a lot of things about markets and potentially politics, but really I think one thing we can agree on today is uncertainty is extremely high. And this is a measure here that we like to look at that gives an indication of the levels of uncertainty. And it's a qualitative measure. It's derived from scraping news sites and measuring how much reference there is to uncertainty. But what I think is really stunning here is the very high level of uncertainty rivals some of those big moments in financial markets like COVID and the financial crisis. So if you've been feeling uneasy for the last couple months, you're not alone here. So how does this translate into the economic data? Well, there's two types of economic data. There's soft data, which is more opinion-based, and then there's hard data, which is more numbers-based. So the soft data, we get readings pretty quickly. They're real time, and they can give us an indication of how things are going. Here's a number of confidence measures that we like to monitor, and I think what's notable on these charts is they've all been falling off a cliff. And also what's interesting here is this chart ends on March 31st. Liberation Day, April 2nd. So already going into Liberation Day, confidence was plummeting. What about the hard data? So the problem is we haven't gotten a lot of the hard data since Liberation Day, but there have been a couple metrics that have come out. The first is the employment number. So we got an employment number for April, and it showed the creation of 177,000 jobs. That was actually above expectations and in line, or roughly in line, with the 6-month average that we've had. So employment so far has been holding in pretty well. A second metric we got was GDP. So we got our first look at Q1 GDP, and that headline number was a little more troubling. It came in at negative 30 basis points. So for those of you who know what the definition of a recession is, it's 2 negative quarters of GDP. So we have one. So that was a little concerning on the headline. However, most investors dug through that number a little bit deeper and found that there was a drag from net exports that totaled negative 5%. And why was that? That was because companies were pulling forward, right? They were stockpiling. They were trying to import as much as possible before those tariffs went in place. So that large drag, if you pull that out from that kind of unusual activity, the rest of the indicators actually were holding in okay too. So we've seen soft data that looks somewhat frightening. We've seen hard data that hasn't really responded. Well, what are markets doing? Markets, they don't wait for the hard data. So the bond market clearly responded to the Liberation Day announcements. We looked at the long bond because that was the one most sensitive to the news item. The long bond moved almost 50 basis points higher in that week following the Liberation Day announcement. Looking back over time, that's the largest one-week move we've seen since 1987. So that was a pretty big deal. And it caught a lot of people's attention. Investors most certainly were focusing on this big move in the Treasury bond. The media outlets, we were getting calls from the press asking, can you help explain what's going on? But probably most importantly, the Trump administration noticed this. And we think this is a big reason that there was that pause that 90-day pause in the tariffs. The Trump administration did not want to risk the unhinging of the bond market. Why do they care about the bond market? Well, we have something called a deficit that needs funding, and they are going to need to come to the bond market for a lot of money, a lot of times, and they don't want to do it at higher rates. So they were very focused on this, and they didn't want this to become unhinged. So outside of the Treasury market, what about the other sectors within fixed income? So this chart's to show valuations across different areas of the fixed income markets. So the chart on the left is where valuations were when we started 2025. The chart on the right was the kind of unfilled in line is post-Liberation Day, and the shaded area is where we stood at the end of April. So the way to read this chart, if you're looking at the left-hand side, Treasury yields. We looked over the last 20 years, and when we entered 2025, Treasury yields were higher than they had been 90% of the time over the last 20 years. So attractive, right? High level of yields. Credit spreads, though, look over to the right. U.S. investment grade credit spreads, only 1% of the time in the last 20 years were they tighter or more expensive than they were at the beginning of the year. And then the other sectors fell somewhere in between. Fast forward to Liberation Day, and what happened? Well, risks moved, and we saw big movements in the credit spreads. You look at investment grade credit, moved up to the 40th percentile, high yield spreads, 50th percentile or higher. Very large move. I think there's really two ways to interpret this chart. The first is in fixed income market, valuations really did correct and move around and were no longer so rich. But from more of a capital markets perspective, in a way I think this was encouraging because while there was a big shift, it wasn't to extreme levels. The credit markets did not panic. They adjusted, but they did not panic. So here's another way to look at that. This is credit spreads over time, investment grade credit and US high yield. We've also shaded in the periods of economic recession, just to give a sense of how extreme credit spreads might get. And so what credit spread does is it really is the compensation you get for taking on the additional risk of default on a corporate bond versus a treasury bond. So the shorthand here is higher credit spreads, bad, lower credit spreads, good. So you can see the blowout in credit spreads in those two periods. We'll now look at the right-hand side, just a little hookup. Didn't move up very much compared to some of these more historic times of financial difficulty. And then here we're shading in yellow times where we didn't quite end up in a recession, but people were very concerned we were on our way. So think of 2022, when the Fed was raising rates very rapidly, and many thought we would be going into an economic recession. Those levels as well, much higher than where we reached during what we're now calling the tariff tantrum. So with that backdrop, what are our thoughts on fixed income markets? Well, I'll start high level and say we think now is a good time to be in bonds. And it really comes down simply to income. There's a lot of yield, a lot of income in the fixed income market. And this chart gives some perspective of that over time. This is all the yield available in the public fixed income markets year by year. Looks pretty attractive today. But if it was only just this simple, you could end here. We think that there's a lot of nuances in the fixed income market. And so at Allspring, we do a few things that we think differentiate the way that we construct our portfolio. So the first thing that our team does is we take a 6-month outlook. So we look forward a couple quarters to anticipate what we think is going to happen and then structure the portfolio to reflect that. That's different than many others who will take a longer, like 3 to 5 year macro view. The reason we like the shorter view is frankly it's easier. It's a lot harder to figure out what's going to happen 3 to 5 years out. We also think you can get anchored in long-term views and you might miss some of those inflection points. On the other hand, you don't want to be too short-term focused. I mean, imagine if you were changing the portfolio day by day with the headlines. That probably wouldn't have ended so well. Secondly, we employ what we call our multiple lever approach. And in some ways, this is a fancy way of saying diversification. We think about global fixed income markets as a very diverse space to invest in, and we want to take advantage of that. We think of all the different sectors as levers we can dial up and down, and it helps us construct better portfolios. And then lastly, we take an unbiased approach. which means we don't want to set the portfolio up to be environment dependent, but rather we're going to shift to where the relative value is. So with that in mind, these are our top 5 ideas, and these are things we're implementing today in our portfolios. The first is duration. So duration is important in a portfolio because it can provide a ballast to the volatility of the equity markets. It also can provide a hedge to a recession scenario. Along the yield curve, we're favoring the 5-year part of the yield curve. We do think that is more correlated with what the Fed is doing. Our expectation is the Fed's going to cut rates towards the end of the year, so we want to be more correlated with that. We're underweight the long end of the curve because we think it's at more risk for inflation expectations. If people become more worried about inflation, we'll see more upward pressure out the curve. So that's generally referred to as a curve steepener position. Secondly, if you're making an incremental allocation to fixed income, we recommend doing it in the public markets rather than the private markets. And our firm's done a lot of work on this topic, and what we've found is that in a higher rate environment, which we're in a higher interest rate environment, public tends to outperform privates. It's also a more liquid asset class, and I think with all the volatility going on, investors appreciate being in an asset class that's more liquid. Third, focus on high quality carry. This is another way of saying tilt towards income, but don't do it by reaching to the lowest quality sectors within the market. There's a lot of income available. If you look in some of the high quality sectors, our favorite is securitized, which is structured product. These are bonds that are collateralized by assets with strong cash flow. Fourth, be flexible with corporate credit. So while credit spreads are on the richer side still on a historical basis, we do think you want a foundational allocation here because corporate credit tends to outperform over a market cycle. But we don't think you want to have a max allocation because if we do move into a recession, the default rate's going to go up, we're going to see credit spreads widen, and there'll likely be a better entry point. And then lastly, cast a wide net. This goes back to the concept of diversification. I mean, we believe in any market environment, but this one in particular, I don't think it's the best way to be positioned to be focused on a single sector. Instead, take advantage of the diversification properties of having lots of different types of exposure in your portfolio. So with that, I'll wrap up on this last slide and just reiterate how constructive we are on fixed income. We think it's a great time to own bonds in your portfolio. This chart shows what's called the break even, and effectively it tells you how much yields can rise or credit spreads can widen before you start earning a negative total return. And so the general move up here in this chart, right up to the right, means there's more cushion available today in fixed income. So even if we do have some upward movement in rates, you have some protection against that because every day you're earning your coupon. So with that, I will wrap up, and I just want to thank everyone for your time and also for the opportunity to participate in Secure Futures Conference this year. Thank you.
Thanks so much, Janet. Really appreciate those insights and that perspective as well. Our next speaker is Evan Scorpin. Evan joined Leading Edge in 2018 to build out the public investing strategy. He led 8 successful investments into public companies within Leading Edge 3 and 4 before launching the public fund in 2021. He began his career at Bain & Company and holds an AB with honors in math and economics from Williams College. Please help me welcome Evan Scorpin.
I was wondering who was going to have this lead-up music. Thanks.
Hey everyone, can you hear me okay? Thanks so much for taking the time. Thanks so much for having me. I mean, it's an incredible organization, so thank you. I'm going to take this a 180. You've heard a lot of macro conversations. That seems really hard. I'm going to go super micro now and talk about a specific company in our portfolio that we're pretty excited about. So just to start though, my name is Evan Scorpin, Lead Edge. We take an old school approach to investing. We run a concentrated, long-only fund, 8 to 10 names at a time, focused exclusively on small and mid-cap companies. We take a private equity approach to the public markets, meaning we make significant ownership investments into public companies and work alongside the management teams to drive shareholder value over multiple years. Today, I'm excited to talk to you about Atleos. It's one of the core positions in our fund, and we think it's particularly exciting because it presents an asymmetric investment opportunity. We think it's one of the most misunderstood small cap companies in the market today. What we like about it is it's trading at a particularly low valuation today, just 6 times EBITDA, 7 times cash flow. Yet, we think there's pretty significant, a 3 to 4x upside story if the team can execute on their vision. I imagine many of you have never heard about Atleos, so let me just start and give you an overview of what the business is. First, Atleos is a global market leader in a stable, non-cyclical end market. They've got a razor blade business model with 87% of gross profit coming from high margin, recurring and reoccurring services. They've got a secular growth story driven by a macro trend towards outsourcing in their industry and a blue chip, diversified customer base. It's a capital efficient model, 70% of EBITDA converts to unlevered free cash flow, and a highly aligned board and leadership team with the whole team top to bottom having significant stock ownership and share price grants tied to specific share price targets. The business has a $5 billion enterprise value, $1.2 billion of gross profit, and $850 million of adjusted EBITDA. If this sounds a little too good to be true, I'll admit I've omitted 2 things. So let's just jump right into the elephants in the room on the business. The first elephant in the room here is that Atleos is a recent spin-off from NCR. NCR was a large conglomerate with a history of poor returns in the public markets. A lot of investors have baggage when they hear the word NCR. Unfortunately, there's a second elephant in the room. The razor blade business model I just mentioned, well, they're in the business of selling and servicing ATMs. So let's dig into these before we get to the pitch. First, on the NCR baggage, we admit there's some baggage here. NCR has a long 20-plus year history of lofty projections with stagnant earnings per share. Over the last decade before the spin, NCR generated $11 billion of cumulative EBITDA, but only $1 billion was returned to shareholders. Where did the 10 other billion go? Well, $8 billion of it was reinvested back into the business via CapEx and M&A. I don't have to do the math for you. $8 billion invested with flat EPS. Clearly, there was a poor return on invested capital. The share price was flat. You have good reason to understand that NCR has some baggage. And this is a scary thing to say, but we believe the setup post-spin is different. First, those slides that I just showed you on the last page, they're from a presentation. We were invited to participate at Atleos' first board meeting as an independent company. We were invited to come present, and exactly the message we were given by the chairman was, can you please educate our new board on all of the baggage that came with NCR, because we want to do things different this time. Honestly, inviting investors to come in and deliver a message to your board about how bad you've been for the last 10 years takes real courage. And so, we were impressed with their willingness to listen and to learn. Second, Atleos is actually the gem asset. When NCR broke apart, the entire leadership team retired. Only 2 executives are still working there, the chairman of NCR and the CFO. And they both chose to leave NCR and join Atleos, this small spinco, in what apparently people kind of have this negative implication, oh, it's an ATM business, why would you go there? So importantly, the only 2 executives that stays, they voted with their feet and they went to the Atleos spinco. So they voted with their feet and they voted with their wallet. Both of them have significant ownership stakes in Atleos, and all of their upside is tied to specific share price targets and cash flow targets over the next 3 years. So there's really great alignment here from top to bottom. The second elephant I just want to address is the cash business, right? It's an ATM company, and people have this perception that cash is going away. Here's a slide, headlines about the demise of cash going all the way back to 2003. In 2003, the Wall Street Journal wrote, "We may be headed to a completely cashless society." The New York Times wrote in 2007, "The cashless society has arrived." Every year since then, You hear nonstop sensational headlines about the death of cash. And all this would lead you to believe that this must be a market in secular decline. The data, however, couldn't be more different. This is a chart from the Federal Reserve of cash withdrawals in the United States going back 20 years. And what you've seen is, despite all these headlines, cash withdrawals grow at an incredibly durable 2 to 3% CAGR each year. So I ask you guys today, please ignore the sensational headlines. Let me tell you the truth about cash. The truth about cash is that the currency volume in circulation has grown at a 7% CAGR from 2016 to 2023. As I showed on the prior slide, the total cash withdrawals from ATMs in the United States has grown at a 2 to 3% rate for the last 20 years. These aren't random people going to Vegas and taking mountains of cash. In fact, 40% of ATM users visit an ATM twice a week. And a major trend towards US bank branch closures increases the need for ATMs as an alternative method to dispersing cash and receiving cash back from bank customers. But look, what I'm hoping I can convince you by the end of this presentation is you don't need to believe that cash will keep growing at a 2 to 3% rate for Atleos to succeed. Because in fact, if cash ends up peaking and we start to see a decline, I actually think, and I'm hoping I can convince you by the end of this presentation, that that actually could be an accelerant for Atleos' business. As there's a wave of outsourcing going on, and a decline in cash would only serve to accelerate that outsourcing, accelerate Atleos' services business, and ultimately drive their path to becoming an industry utility faster. But I'm getting a little ahead of myself, so before I get there, let me spend a minute first explaining why Atleos has the makings of a great business. It's a dominant player in a stable oligopoly market, beneficiary of durable secular growth trends as bank looks to outsource its non-core services. They've got a structurally efficient business with the potential to generate over $7.50 in free cash flow per share. We think it's an increasingly strategic asset that could be worth $75 per share or more. Let me walk you through each of these. First, on the dominant market position, one thing we love about this industry is no one is launching a new ATM business today. And so the competitive landscape that exists today is exactly the same competitive landscape that existed 10 years ago, and it's the same players that are going to be in the market 10 years from now. It's really a three-player market. NCR Atleos has 40% market share. Diebold, which just went through a bankruptcy, has 25% share, and Hyosung is the third player, 21%. We ran a customer survey earlier this year. We actually went out and surveyed 56 folks that work at banks and run their ATM division. And we asked them, who do you love working with the best? And Atleos, again, not only had the highest market share, but they got the best customer satisfaction scores, 53% NPS score. Higher than Diebold, 38, and much higher than Hyosung at 25. So not only are they the largest, but they're the most respected player in the market. And they have people think of this as a hardware company, right? They're in the business of selling ATMs. Over the last 10 years, Atleos has really transformed their business model. And today, only 13% of gross profit comes from selling ATMs. 87% of gross profit comes from attaching services, software, and transaction revenue. These are highly recurring revenue streams with strong gross margins and true network effects. Let me explain. Historically, if we go back in time, ATMs were viewed as strategically valuable parts to the bank. Wells Fargo viewed their network of 11,000 ATMs, shiny green ATMs, as a key part of their branding. And so Wells Fargo of the world said, it's our brand, we need to do it all in-house. In that old economic model, all that Atleos could do would be sell ATMs to Wells Fargo, and Wells Fargo would do everything else themselves. Over time, the decades of kind of doomsday forecasts about cash, plus Atleos' work over the years to build customer relationships, has changed that dynamic. And today, banks realize that ATMs are a cost center, and an annoying one at that. Banks aren't particularly good at operating them, and they're looking for partners to outsource as much of that ATM servicing as they can. So what are these services? It started actually with them first outlining what they call second line maintenance, which is someone puts a piece of gum in an ATM or drops a Coca-Cola in. You need someone to come in and really do kind of like pretty extensive servicing. That was outsourced first. Atleos has had that business for a while. The second outsourcing trend was actually cash. They quickly realized, oh, if we don't want to have our bank tellers moving around that much cash, we're going to outsource cash in transit and cash vaulting. So we're second line maintenance. You can see on the right-hand side of the page here, 96% of banks outsource that today. Cash in transit, somewhere in the 70 to 80% outsourced. But what we're increasingly seeing is that banks are saying, I actually want to outsource all of it. I want to outsource real-time monitoring. I want to outsource cash forecasting. I want to outsource even the selection and procurement of hardware. I want to outsource it all. And more recently, Atleos, seeing this demand, has launched 2 new comprehensive servicing packages. One, they're calling ATM as a Service. It's a little kitschy name, bear with me. But it's a bundled service offering where they actually go to a bank and say, hey, look, we'll guarantee you 98% uptime, and we'll handle all of that services, all for kind of a flat $1,000 or $2,000 per ATM per month. We'll do it all for you. They have another service offering called Network, where actually they say, look, let's go one step further. You don't even want to own the ATM. We'll just make ATMs, we'll install them, and we'll run the ATM network for you. Both of them, though, it really comes out to about $1,000 to $2,000 of sticky, recurring service revenue per ATM per month. In that survey we asked, I mentioned we kind of did a proprietary survey. In that same survey, we asked banks if they were interested in outsourcing more in the future. And nearly 40% of respondents says they were. When we asked what they wanted to outsource, you could see on the right, they said they want to outsource everything. Banks want to be technology companies. They don't want to keep ATMs stocked. They don't want to do repairs and maintenance. So, and this emphasis on services-driven growth has resulted in a much cleaner financial profile now that Atleos is spun out of NCR. Last year, they did $780 million of adjusted EBITDA, which converted to just over $500 million in unlevered free cash flow. And they've committed to using this cash flow productively. At the time of the spin, the business was 3.5 times levered. This summer, they'll get that number to just below 3 times. And on the Q1 earnings call last week, the CEO of Atleos said that they're going to, in the next successive 6 quarters, they're going to generate between $600 and $700 million in free cash flow. Just to put that $600 to $700 million in perspective, if they used all of that money towards retiring debt, they could take their leverage from 3 times to just about 2 times. If they used all of that $700 million to buy back shares, they could buy back 1/3 of their company in the next 6 quarters. It's pretty impressive. So what does this mean for shareholders? The company provides a lot of distracting details. The financials are messy with spin accounting. So let me simplify it for you. There's just a handful of variables that really matter. First, the number of ATMs in circulation is roughly flat at 600,000. What matters here is not the number of ATMs, but the number of managed ATMs. These are the ATMs with that sticky $1,000 to $2,000 per ATM per month contracts on them. That number has grown from 15% in 2021 to 18% last year. And now that Atleos is an independent company, it's accelerating. ATM as a Service is growing customers 40% year over year, and their backlog is up 87% year over year. All of this mix shift toward managed services is driving sticky service revenue. Service revenue grew 8% last year and is compounded at a 10% rate over the last 3 years. We think this mix shift can continue to drive services up mid to high single digits going forward. And this service revenue will drive double-digit earnings growth. And EBIT growth and disciplined capital allocation will drive significant free cash flow per share growth. From $3 a share last year to $4 this year, just over $5 the year after, and we think it could do about $7.50 per share in free cash flow in 2027. What makes this even more exciting is not only to think free cash flow per share can double, but I think there's additional upside from the multiple that we as the market are going to apply to those earnings. Today, Atleos trades at $28 a share, roughly 7 times the $4 per share in free cash flow I mentioned. That multiple 7 times reflects all of the baggage of this NCR heritage in the business. If the company can deliver on the plan that I've laid out, I think we can walk that number up to 10 times, so $7.50, kind of $75 a share, just by delivering earnings growth and using the growth productively to pay down debt and return cash to shareholders. But the upside, we're not here for just a double. What gets us really excited is if Atleos really works, in the future, this won't be viewed as a hardware business, and it won't even really be viewed as a services business. In the future, it's going to be viewed as an industry utility. In the future, banks won't want anything to do with cleaning gum out of machines, transporting cash. They won't want anything to do with procuring, installing, or monitoring ATMs. And as the largest vendor in the space with the highest customer satisfaction, Atleos will be the vendor of choice to drive significant services growth, but over time, Atleos could provide a universal network of ATMs that eventually all banks will subscribe to, serving as an industry utility, much like Visa does for digital payments. And that business, that'd be worth a lot more than $75 a share. And so with that, thanks for your time. Happy to chat more about it afterwards.
That was awesome. Thank you so much. You never thought you'd be so excited about an ATM before, did you? How good was that? So I'm really excited. We're at the point in our event where you get a chance to hear the meat of the organization. So I'd like to invite up Brenda Campbell, the CEO of Secure Futures, to tell you a little bit about what's happening inside of the organization, and she's going to bring up to the stage 2 special guests as well, so that you can hear a little bit more about what's happening within the organization. So please help me welcome Brenda Campbell.
Thank you, Joe, and thank you all for being here today. It's exciting to be in a room full of people who understand the power of investing, not just in the markets, but in people. I especially want to thank our generous sponsors and speakers. This event does not happen without you, and we are honored to have your support. I want to invite you to picture something. Imagine a high school student. We'll call her Maya. And Maya is standing outside a classroom. She's peering through the doorway, and inside she sees a small group of her classmates engaged in a lesson about money. They're learning about budgeting, how to build credit, how to set financial goals. Maya watches as they prepare for a financial future she knows is coming fast. And Maya wants to be in that classroom. She's eager to learn. And she knows that she doesn't have someone at home who can teach her these things. But today, we're at full capacity and we don't have the financial resources to open that door for Maya. So she stands outside, left to figure out her future alone. At Secure Futures, we don't want to accept this reality, but the truth is, without you, there are students we cannot serve. Our Money Coach program was designed for historically marginalized and under-resourced teens. Over the course of 11 weeks, students don't just learn financial concepts, they learn to apply them. They're creating savings plans, they're building budgets. Many are opening their very first bank account. For some of those students, they are the first in their family to have a bank account. And they don't do this alone. They have mentors. We call them money coaches. They're volunteers, real people like you who believe in students. They guide them, they hold them accountable, and they celebrate their success. You might actually be sitting next to a money coach right now. Can I ask the money coaches in the audience to raise their hand? Okay, and keep them up because there are so many other people who make our programs possible. So will you also raise your hand if you're a Money Sense or a Money Path volunteer? Or if you're a member of one of our committees, our board of directors, or our advisory council. Please join me in applauding these wonderful people. Okay, so here's the good news. It works. Money Coach works. And we hear it from the students who come back to us years later to tell us how they have avoided debt, bought their first home, shared what they learned with a family member, some even teaching their young children to become financially capable and empowered. The impact lasts a lifetime. But you don't have to take it from me because we have a Money Coach student with us here today, Ebony Dable. Ebony completed the program in 2018, and she's so passionate about Money Coach, she traveled 7 hours from Michigan to be with us here today. Ebony wants you to hear firsthand about the impact you are making possible. So you're in for a treat. It is now my honor to introduce Money Coach alumna, Ebony Dable.
Wow, thank you, Brenda, for the warm welcome. I'm so honored to be here just to share part of my story and how this has impacted my life. Growing up on the north side of Milwaukee in a single-parent household, I was not interested, let alone aware of financial literacy. I was simply just trying to survive. My earliest memories with money were just asking for a few dollars to go to the local corner store to get snacks. And can I be honest? I got a lot of them. I remember watching my mother work multiple jobs at one time just to provide for me and my siblings. And to this day, I honor her for her sacrifice. However, it left little time for me to learn about financial literacy. I didn't know what a budget was, I didn't know what a bank account worked, or how I could set goals for myself. But that changed. So instead of just spending money on snacks and the latest trends, I began to get introduced to Secure Futures. My assistant principal at the time, Ms. Torres, she came to me and said, "Hey, Ebony, I have an opportunity for you. I want you to be a part of this program. It starts on this day, at this time, and in this place." And because I trusted her, I just went. I remember walking into the cold library and seeing some of my friends already there. There was this man with a big smile on his face passing out a huge binder full of information, a binder that I would keep for over a decade. And this man was my money coach, Brian. Little did I know, he was sent to help us. Over the next couple of weeks, we talked about budgeting, saving, credit, investing, loans, and how to avoid college debt. But if I can be honest, that still came. This program has truly changed my life. I opened my first bank account. I learned how to make better financial decisions, but more importantly, I learned information that I could take back to my family and my friends to help us change our financial directory. I'm so thankful that I was able to move forward and now stand here in front of you today. I'm now in school as a 27-year-old, and I'm studying to get my master's in public health and social work. Being over 300 miles away, I'm still connected to this program. Secure Futures keeps me connected through scholarships, networking opportunities, and webinars on various topics. So this is not just a one-time experience, it's become a lifelong impact. So thank you. And I'm not done yet. I aspire to keep growing, and by God's grace, continue to be a light for those who may have grown up how I did, or maybe in a similar situation that feel the same way. I want them to know that it gets better, that one opportunity can truly change your life. And that opportunity for me was Secure Futures. Thank you. Thank you to every single person that has contributed time, mentorship, believing in students like myself. Thank you for seeing us and being able to invest in our futures. Your generosity is not just a gift. It's an investment in a seed that produces lifelong fruit. You're giving hope and investing in dreams, futures, communities, and generations. I'm just one story of many. There are others who've been a part of this program who are now scholars, business owners, community impactors, and world changers. And so on behalf of them and myself, I just want to say thank you.
Wow. Wow. Can we have just another round of applause? It's really hard to get up here and tell your story. Incredible. These are the stories that are so powerful at Secure Futures. It's not just about great programming, it's about the outcomes. We can see it, we can feel it here on stage, and we know there's so many more students that we can reach. I'd like to tell you a little bit about my why. Why my wife and I have decided to dedicate our time, our talent, our treasure to this awesome organization. And for me, this passion starts when I was a kid. So yes, I was passionate about financial literacy as a kid. And some of you know the story. Some of you are looking at me probably like, that's kind of weird, like you're a kid and you like financial literacy. My mom wrote a book called Money Sense for Kids that Barron's published when I was 13 years old. This is literally what we talked about at the dinner table every night. And it occurred to me as I was prepping to be up here, I don't think I've ever thanked my mom for writing that book. So we're 2 days past Mother's Day. I've got my 500 best friends in the room, and my mom flew in from Florida, and she's sitting over here at the Baird table. So thank you, Mom. Thank you for sharing your passion. Thank you for writing that book. And that's how you instantly become the favorite child. It costs $1,250 for us to put a student through the full Money Coach experience. Understand that your donation today can be the difference between helping guide a young person with confidence into their future or having them struggle through it alone. My story is the exception. It is not the rule. There's a tremendous opportunity here. Quite a few of you bought tickets to be here today. We thank you. Quite a few of you are sponsors of this wonderful event. We thank you. Many of you are guests of sponsors, and I can tell you that every one of you is probably happy we didn't ask you to put on a black tie outfit and raise paddles at this event. But understand, if you join us, if you invest alongside us in this mission, it will impact generations to come. This isn't just about the teen. It's the ripple effect through their neighbors, through their family, through their communities. Now let's talk about magnifying our impact. This is really cool. Thanks to the tremendous generosity of our keynote speaker today, Bill Naskovitz and his wife Marion, every dollar you donate today will be matched up to $75,000. That's right. Thank you so much, Bill and Marion, for your generosity. My challenge to everyone in this room, let's not leave a dollar on the table. Thank you for your support. Thank you for your time. And now to tell you how you can double your impact, I'll hand it back over to Brenda.
Thank you, Max. I'm so grateful for your support and continually inspired by your passion for this mission. Simply put, he's a rock star. And oh my goodness, Bill and Marion, I am truly in awe of your generosity, and I just cannot thank you enough for all you've done to support Secure Futures over the years. So we have several ways for you to donate right now from your seat, including Venmo, which you'll see on the screen right now, or by using the QR code or text to give number at your tables and on the back of your program. This allows you to invest via Google Pay, Apple Pay, credit card, or bank account. Or you can use the donation. If you're old school, you can use the donation envelope, write a check and put it in there and hand it to me or one of my colleagues after the conference. If you'd like to donate through a donor-advised fund, there's a link on our website at securefutures.org. Or to give a non-cash gift such as stock or cryptocurrency, please email our development manager, Allie, and you'll find her business cards at your table too. Your investment creates a generation of financially capable, empowered young people. And we promise you, there is no better return on your investment. And now, as we celebrate what's possible when you choose to invest in teens, we want to present this year's Teen Financial Capability Award. This award recognizes an exceptional individual who's demonstrated an unwavering commitment to our mission and significant financial support of Secure Futures programs. To present this award, it is my honor to introduce the architect of Secure Futures, the original difference maker, and the man who is not afraid to dream an impossible dream, our founder, Lloyd Levine.
It's hard to believe, looking out at this group of people, that this impossible dream is actually coming true. And I can't tell you how touched I am, how thrilled I am to have you here. I have literally waited 2 years for this afternoon, and I am thrilled to be presenting this award to my dear friend, Bill Neskowitz. Bill has a BA degree in business from the University of Wisconsin. He served as a captain in the U.S. Air Force. He put together Heartland Advisors, which is an industry-leading investment advisory firm in the 80s. And he has been at the forefront of the industry with his Value Plus fund and his mid-cap strategies for decades. Bill, I'm not sure where you are, but I think you're here. Come on up, please.
Hey, you want to dance? Lloyd, thank you. Thank you so much.
I'm not done.
You're not done. Let's keep it short.
Let me tell you a little bit about Bill. He was a speaker at our very first investment conference. He's been a member of our advisory council since 2010. Bill and his lovely wife, Marion, his partner for 55 years, are the founding sponsors of the Money Path program, which was launched in 2018 and has been delivered to over 50,000 students at no cost. Now, it has been my privilege as the founder of Secure Futures to be able to present this award today. But I read in one of the background pieces on Bill, quote is, he is an avid gardener, which he admits he is better at than golf. Now, Bill, I can testify to both of those things.
Thanks, Lloyd.
But everybody who knows me knows I'm a storyteller. So I want to tell you a story. It's a story from the Jewish Talmud and Midrash, which is the commentary that has been written on the Old Testament. And the story is about a man named Honi. And Honi observed an old man planting a carob tree. And Honi asked the old man, he said, "How long does it take for this carob tree to produce fruit?" And the man said, 70 years. And he questioned the man and he said, "Are you going to be around to participate and eat that fruit?" And the old man responded, "Just as my ancestors had planted trees for me, I am planting these trees for my grandchildren." Bill, in a different way, I would agree that your golf game is not nearly as effective as your gardening. But the gardening I'm talking about is not the garden where you put your hands in the soil. The time and treasure that you have given our community have not gone unnoticed. The numerous organizations and boards that you and Marion have served on have greatly benefited by both your example and your wisdom. Like Honi, you have planted a garden in this community which will continue to flourish long after we are gone. And I'm certain that your children and your grandchildren will continue to follow your example. So, Bill, it is my privilege to give you this award.
Oh, thank you. Oh, gosh. Thank you, Lloyd. Thank you very much. Thank you. Brenda? Lloyd? All right, thank you. Thank you, Lloyd.
You got it.
Okay. Sure. Well, thank you so much. What an honor. Gosh, by the way, I have a couple questions first, though. Crypto. How much crypto do you expect to receive here after this event? I mean,
I don't know.
just in case. By the way, my check is in the mail. Have you heard that one before? In any case, what an honor. It's such a great organization. And boy, you've come a long way since 19 years ago, that's for sure. I'd like to thank my star, Marion Naskovitz, my wife of 55 years. Would you please stand, honey? She's made me great. Thank you, Marion. Also, son Will, who is here somewhere, the CEO of Heartland Advisors, and a lot of the staff, too. Thank you, Will. Allowed me to get involved in a number of these wonderful causes. So thank you again. I'm so glad you came. And I look forward here to the wrap-up here, which we're going to have with Joe. Thanks again.
Would you like me to take this?
Sure.
Okay. I'll put that away, and then we're going to take your name tag off for this interview.
Okay, great.
Okay, and then you're going to take the first seat here.
Okay, perfect.
This is advance here.
Great.
The green. All set?
All right. Joe, are you ready?
I'm ready. Perfect. Thank you.
Before we start, can we just, it's always good to know the room, right? These people have been sitting here now for about an hour and a half, and how about everybody just stand up for just take a little break here for about a minute. But I do have a quiz here for you. This is spur of the moment. Are you ready for this, Joe? So let's just take a survey of, just from the investment, whether it's stocks, bonds, commodities, you name it. For those of you who have been active in the securities business, at stocks, bonds, commodities, since 1999, stay standing. Meaning you were an investor back in 1999. Remember that? That was the new era? That was the new era of investing? Okay, that's a fair amount of people. How about the crash of '87? Who was investing or in the markets back in 1987? Well, we're getting down to, looks like about 20 or 30 people. How about, Marion, you can sit down, go ahead. She was. How about May Day, 1975, when commissions were no longer fixed to buy and sell securities? Anybody around then? I think Ted Kellner is standing back there. Oh, yeah, he is. Ted, okay, that's a good read. There's just a handful of people who saw the illustrious 70s, the nifty 50s, back in the bear market of 70s, 74s. That's good history. Thank you. Thank you, Joe, for putting up with that.
Oh, absolutely. My pleasure. So I thought I'd start out today, and many of you who have been here before know I have a couple of questions, and Bill and I took a couple of minutes in advance of this to just share some thoughts, but we're going to go in whatever direction we end up going. But I want to share a true story with you and kind of help you get some perspective. I get a lot of credit for this conference, and it's very much appreciated. But the reality is this conference wouldn't exist if this guy hadn't said yes. So here's the story. It's 2008, and we're in the teeth of the economic crisis. You can't do a chicken dinner, a golf outing, or anything. Nobody wants to spend money. Some of you remember that time. It was a tough time. And you didn't email people then either. You still use phones. So I called up Bill, and I said, Bill, we're doing this idea. It's a brand new idea. We're going to do this investment conference. Would you come and share your most compelling investment idea with us? And I had 3 people in mind who I really wanted to do the conference. Bill, Ted Kellner, and Marianne Stanek were my big 3. And so I called Bill up, and he said, well, who else you got? The reality is, I got nothing. So I'm like, well, I think I got Ted and Mary Ellen who are interested in doing this. I haven't even called Ted and Mary Ellen at this point. So he went along and said, well, let me think about it a little bit. So then I called Ted up, and I said, Ted, here's the idea. We're doing this conference. Would you share your most compelling investment idea? Well, who else you got? Well, I think Bill's doing it. So, and I think Mary Ellen's going to do it. How about you, Ted? Let me think about it. So then I called Mary Ellen up, like same recording. Who else you got? I got Ted and I got Bill. They're going to do it. So as soon as Mary Ellen said, well, let me think about it, I thought I knew it. So then I called Bill back up, and I said, Bill, I got Ted, I got Mary Ellen, you got to do this. He said yes, and we're off to the races. And that was our first conference. That was back at the Milwaukee Center. And I think we had 135 or 140 people in the room. What a great experience. And that really got us going. I mean, without you saying yes, I'm not sure that we'd actually be here today. So thank you so much.
Well, Joe, you're a good salesperson.
Yeah.
Congratulations.
That's what Northwestern Mutual will do for you. So what I thought we'd do is we'd start out today, this is the first time I've had 55 years of investment experience at the table with me here today. And I thought, what an incredible run to be able to go through the decades, if you will, and kind of have some perspective in your life as an investor. So you started investing back in the 70s. And as we think about the 70s, for those of you who are around, and for some of you, you weren't born yet, but we had the Watergate scandal, we had the 1973 oil crisis, inflation was super high, Nixon impeachment and the resignation. What was it like to be an investor back then in the 70s?
Challenging, as it is just about every decade. Actually, my investing career started when I was age 12 with paper route money. I had a Sentinel route, and my father introduced me. He was a teacher here in Milwaukee. And for some reason, he got interested in the stock market and asked me to look at it. And I started to invest way back then. The 70s, volatile period, that's for sure. It was the Nifty 50. I mentioned that earlier. I don't know if there's a few in the room who might mention that, but that was, again, another, perhaps the first new era, 50 stocks to buy and pay 50 times earnings for them, meaning 50 times anything would be about a 2% earnings yield. And it was very difficult at that time. I was a broker with Dean Witter. That's where I met my lovely bride, Marion, back in San Francisco. Dean Witter was a partnership, a regional firm headquartered in San Francisco. So for 3 years, 3 or 4 years, these 50 stocks just ruled the roost, and nothing else mattered. Good companies, whether it be a bank, a manufacturing company, you name it, people didn't care. They wanted to buy Xerox, Polaroid, Eastman Kodak. Those were the glamour stocks, the one decision stocks back in the 70s. And here you are, a broker, trying to get people interested in opening up an account with you. And it was darn tough.
Yeah.
But we survived. And actually, I reread the Intelligent Investor. I had that slide up here, The Margin of Safety, a central concept of investment by Benjamin Graham, who was the father of security analysis. He was the teacher, the professor that Warren Buffett spent time with in Columbia and learned his skill set there. That's a long answer, Joe, sorry.
No, but that's spot on. So let's take you through the 80s. I mean, suddenly we're in the 80s, fax machines become ubiquitous. Some of you still don't know what fax machines are, or maybe you do from your medical records. Ronald Reagan presidency, fall of the Berlin Wall, CNN launches, personal computers start to be broadly used. That started to change the way people actually did investing or did research as it relates to investing. How did you implement that into your way of looking at the world?
Well, the market broadened out after the Nifty 50 collapsed. Check out the price for Polaroid or Eastman Kodak these days, or Xerox. Xerox is down to $4 a share. So the market broadened out, and all of a sudden people realized, my gosh. Peter Lynch came out, I think, with a bestseller, a book on investing, and he just said, hey, a secret to successful investing is if you have a local business that's doing well, you like their products, you like the quality of buy the stock. And people started to do that. So I think when I started in the business, there were like 4 million investors in the US stock market. So year by year, that grew substantially. Now we have, 65%, 64% of Americans, meaning well over 200 million people invest in stocks, either through their 401k or their another plan or directly. So the 80s, locally, I have to tell this one story. There was we had 3 breweries here in Milwaukee that were Schlitz, publicly traded, Pabst Brewing, publicly traded, and Heilemann, which was LaCrosse. Miller wasn't also ran. No one drank Miller High Life. I mean, you either was Blatz, Pabst, Schlitz, or Heilemann. And a fellow up in Minneapolis, all of a sudden, some sophisticated money discovered the values inherent, let's just call them in secondary stocks, local, regional companies. His name was Jacobs, and he tried to take over Pabst Brewing. Right. And that failed. The company thwarted him and eventually spent all their money on tin cans, believe it or not, stocking up tons of cans to make the company less attractive, and ended up in bankruptcy. But the story is that the market broadened out substantially, and we, after reading the Intelligent Investor and coming up with 10 parameters to buy stocks, it worked really well for our clients, and we prospered because they prospered.
So as we jump into the 90s, some of the important events of the 90s were we had the end of the Cold War, the Oklahoma City bombing, rise of the internet. I remember 1996 seemed to be kind of this thing called the web page became a reality in most people's lives, and people could start to search. You certainly had a change in pop culture. Seinfeld and Friends were the big TV shows at that point in time. And you also saw this change where individuals started to be responsible more for their financial future. The individual retirement accounts, 401k plans where people were making decisions. Did that change the way you thought about investing or how you executed, or was it just more of the same?
Well, it was, again, a difficult period. At that time, we had started the investment management business, launched the Value Fund in 1984, and other funds after that. And again, it was the new era with the arrival of the internet, and people were just utterly infatuated with it and were willing to pay ungodly prices for all sorts of new companies, and technology ruled the roost. In fact, the S&P 500 really became more of a technology index. In fact, it went up over 20% a year, 95, 96, 97, 98, 99, and then that reverted as New Era turned out to be not so hot as expected, which set up another great period for value investing.
Yeah. So we're into the 2000s. You know, again, for those of you, a little history lesson, we had the 9/11 terrorist attacks, wars in Afghanistan, continued rise of social media, which influences the way people thought about things, the economic boom and subsequent bust of the 2000s, the great financial crisis, low interest rates, Barack Obama presidency was a watershed event. How were you thinking about and investing during that period? And where did you see the opportunities?
Again, value investing and Benjamin Graham type principles of investing did really well during that period. It was a value decade, the early 2000s, and sort of peaked out right after the great financial crisis was settled, 2010-11. It's a fantastic period to invest. Maybe I can just flip to one of my slides here. I guess there are always difficult markets, and investors have to deal with the emotional side of the marketplace. This past 3 months, I guess, is a good example of what recently has happened here with the tariff situation. But the two principal motivators in the marketplace are fear. When Trump put on the tariffs and stock prices plummeted 10%, 20%, 30%, 50%, almost overnight in some cases. People were fearful, and a number of people, I think, just ran for the hills and just sold into those headlines. And to be a successful investor, I think you have to sit back and, first of all, understand what you own. You do own a piece of a company, not just a piece of paper. Even if it's 100 shares, you own a slice of that pie. Why did you buy it? What do they do? Did their products disappear because he put on tariffs?
Yeah.
And I think the whole tariff, as part of our GDP, is only $3 or $4 trillion in terms of what we import versus what we export. It's just $1 trillion difference. So it's actually a fairly small part of our economy, but it certainly made the headlines and scared the heck out of a lot of people and forced stock prices down. At Heartland, we just sat on our hands, principally, and did some buying into some of that weakness. The other, of course, key emotion is greed. After Trump was elected back, just think, when he was elected back in November, the markets just took off like a rocket, and you had some emotional buying just because the market's going up, momentum investing. Again, be careful in terms of these extremes and try to manage your personal emotions to deal with them.
Yeah. Can you help the audience understand how you define value investing? I mean, compared to what the S&P 500 has become recently, which everybody tends to associate as the benchmark for performance, value investing is a different way of thinking about the world.
Right. This is another way to look at the market here in relation to GDP. The Buffett indicator, U.S. stock market value to GDP, which is an all-time high. Nick, in his presentation, I believe, looked at another example of this. So we're at all-time highs in prices, which the S&P 500, for example, is trading at 30 times GAAP earnings, generally accepted accounting principles. It's never been this high. It hit 31 times, at its market high back in February or so. In any case, value would be looking at a price to earnings and as a yield. So if you're paying today, the S&P 500 is at approximately 22 times. It's throwing off an earnings yield of about 4.5%. So Graham would say, gee, 4.5% doesn't seem that much, especially when we've got 10-year bonds at 4.5%. For riskless, supposedly, 10-year treasuries at 4.5%, with an earnings yield of less than 5%. Perhaps I've got to be a little bit more discriminate in terms of buying securities with those high of a price to earnings versus something a lot less. So value to us is in competition with the bond market, the treasury bill market, what you can get in different markets. Nick talked about the foreign markets, which are substantially cheaper than the US market. He displayed that. They're selling about 14 times earnings, which is about a 7% earnings yield. If you bought the entire company, 7% on your money as an owner after tax. That's value investing versus, to me, I don't own the S&P 500. I know a lot of people do, and it's worked tremendously here, but it's not the cheapest part of the market today because of this relatively high valuation. I don't know if that helps, but
Yeah, no, that's super helpful. So as we think about, the last decade of investing, if you will, some big stuff happened in the 20s. We had the pandemic, we had the protests from George Floyd, January 16th Capitol attack, this great thing called the National Basketball Association Championship in 2021, the Ukraine war, a lot of volatility. And then you got this world of meme stocks. And, as a guy who has seen so much, how do you not just go, what the hell is going on here? It's just a weird world we live in.
well, it was a bit of a crazy market, wasn't it?
Yeah.
When a local company went from, who's not earning any money, went from $5 a share to $50 a share. The insiders cashed in. They sold stock to the public, to the meme buyers. So it's really crazy. And again, it comes down to the value of the company. What is that business selling for in total in the marketplace versus what is it throwing off in terms of earnings and cash flows and perhaps a dividend? So, and it's concerning today because in the crypto market, there are over 1 million different coins to choose from. Over 1 million. Forget Bitcoin, which is perhaps going to be with us for a long, long time. A $2 trillion market in Bitcoin. However, there's another trillion in over 1 million different coins. Dogecoin, the joke coin, last time I looked, was selling for $31 billion. The entire value of Dogecoin, $31 billion. I think a great opportunity might be to figure out a way to short Dogecoin. They have unlimited coins. They'll issue as many as you want at 30 cents or whatever the price is per coin. But people are still speculating with their hard-earned money in this marketplace. It's hard to imagine. They have no idea what they're doing, in my view. I don't even know if they think they're speculating.
Yeah, I think people are just hoping,
Right.
and sometimes you hear the story, hope is not a strategy, be careful.
Right.
So as you think about your investing career, what's kind of surprised you the most as you reflect back?
What has surprised me the most? That I'm still alive. I can remember going to the Grenadier with a number of people in this room in 1987 after the crash when the market sold off 40% or something like that in one day. I think we closed that bar down. In any case, so thank you, Marion. It has been a very surprising period of human emotion extremes, euphoria and also just desperate fear, where people are dumping stocks wholesale because of some headline which is causing angst.
Yeah.
Yeah.
So
the herd mentality, I guess, consistent herd mentality.
Well, to some degree, one would argue it's probably gotten worse as people have access to information in so many more ways than they did in the past. The ability to create a herd mentality has just been amplified dramatically, and a little bit scary that way.
Well, I guess as humans, we love to do what's popular, right? We're not going to get fired or as a fiduciary, we're not going to be at risk if we buy the S&P 500, for our 401k or our pension plan,
Right.
versus going, taking the risk and hiring, a good manager such as Evan or someone else.
Yeah. So take me through the thought process that you had in the creation of the Heartland Funds. I mean, it's a extraordinarily well-known name in our community, was garnering significant headlines for a long period of time with the performance and the track record. But why did you go from the brokerage type model back in the day to creating the Heartland Funds?
And that was back in 1984. Actually, we preceded it with a private fund in '82 to see if I could manage money with about seven or eight friends, and
How'd that go for you, Ben?
it worked well.
Good.
And so then we started the value fund in December of '84. We did it because it was too difficult talking to investors about, X, Y, Z, new idea every time. Let's just create a fund where they immediately get diversification, lower cost. It's a no-load fund with an expense ratio below somewhere around 90 bips or something
Which
like
at that time, that was kind of a novel idea to have a no-load fund.
Right.
I mean, most funds
Well,
were
it
paying-
actually started low load, and
Okay.
then we jettisoned that promptly and it became no load.
Yeah, for those of you who don't remember, back in the day when you were buying a mutual fund, I think it was 5.75% commission a lot of times, or 5%
Right.
commission just to get in was not unusual. So to have a low load or a no load fund was kind of this new thing.
Right.
So you create the fund group to be able to give people diversification, and frankly, they don't have to be thinking about the investment ideas, and you can be managing that. And then just in terms of how decisions were made and how you collected information, I mean, you didn't have the personal computer, you weren't able to look up stuff. How did you find out about a stock? I mean, what's a history lesson?
You think about today's speedy communication, instant communication versus what was going on in the 70s or 80s, or even 90s for that matter. Just to get an annual report, you'd have to call up the company and or write for it, and they'd send it out. And I can remember doing that with a local company called, the fund started with 5 or 6 local companies. The first orders that I called in, came from Marcus Corporation, the Marine Bank, which was a well-run regional bank here, which we knew well, and others that were in Wisconsin.
Yep.
But again, it comes down to relying on other brokers. We've done business with Baird and Company since inception. We rate them very highly in terms of their research, and easily 20 other Bairds or regional brokers which generate research from all over the country, if not the world. That's a source. We also look to see just overriding trends. My gosh, what's working, what's not working, what's growing, what isn't, what are insiders doing? For example, a company that we've been watching for a while today, we just saw a significant insider buy by the CFO. The key financial officer just bought stock with his hard-earned money. That might be a tip-off to perhaps we should dig a little deeper in this particular company, which we followed for perhaps 5 years or more.
Oh, it's terrific. So I want to ask a couple of specific questions to the extent that you feel comfortable answering. What was the best investment you ever made, and what was the worst investment you ever made?
I think the best investment I made was rereading Benjamin Graham. I studied him at Madison in the finance courses there, but that was a good investment to pay $15 for that book and reread it, and
How'd you
completely
find that book
changed.
for $15? You can't buy that book for $15 anymore.
Well, yeah. Back then it was a steal, I guess.
Yeah.
Best investments in terms of the fund, I can remember we were accumulating Midwest Express probably for the second or third time that we had been in the company. I don't know if people remember Midwest Express here, and how many people have remembered Midwest Express? Great airline. Wish it was still around. I think we all wish it was still around. But we began accumulating the stock. It was down from $20 or $30 a share. Airlines do go up and down, and the stocks as well. The stock was at 8, 7, 6, and we're buying more at 5, 4, 3, 2. This was just as the great financial, or just prior to the great financial crisis, but it was a difficult period. It was after 9/11. It was at trading at 150, and someone from Baird called our trader and said, gee, there's 550,000 shares of Midwest Express to go. So we bid 99 cents and we bought it. That Midwest Express, a number of years later, was bought out around $15 a share. So that one worked out fairly well. That was a good investment.
Yeah, 15 beggars count as good investments.
Well, perhaps our average price might have been 2 or 3, but it still was
yeah.
It was a nice return.
So worst investment?
We've had a number of worst investments. In fact, I mentioned it, Evan, after he made his presentation on ATMs. They do have a competitor, which he mentioned, and that was one of our losing positions way back when. Again, I guess the key, we all make mistakes, things happen, is to recognize them early and to move on, especially if the balance sheet is impaired or becomes impaired, or people change, the key CEO leaves, or things like that.
Yeah.
Cut your losses short.
Yeah.
And that's difficult for all of us to do, to admit, hey, we're wrong.
Or sometimes you're right, but the market's wrong, but you got to wait long enough for the market to come around to recognize that you're right. That's tough, very tough.
Right.
So
I want to flip, if I could. Let me just,
yeah,
I don't know how much time do we have left.
we're doing great.
Great. I want to flip to this one slide here, if I can. So this is the top 10 stocks which sort of rule the roost, similar to the Nifty 50. And they're all great companies, fantastic growers. They've been phenomenal investments over the years. But I just want to share with you the valuation table there in terms of price to earnings. You'll see them as high as, is that true? Over 100 times? I think Tesla this year is going to earn $2. The stock's about 100 times earnings.
Yeah, Palantir's at
So
200
again,
times
if you
earnings.
pay 100 for something, you get $1. That's a 1% on your money. Tesla might have great products. Let's not confuse their products with their, the stock in terms of valuation. On that list, we own one and have for a long, long time. We have private accounts over and above the funds, and this is a multi-cap, meaning small, mid, and large. So we've been a holder of Troy and Colin and Will as well run our mid-cap fund, but as a spin-off of that, we have private accounts, and that Google represents, we think, is a phenomenal value today in a fairly rich stock market. Google's trading about 15, 16 times earnings. The issue is, again, competition.
Right.
Is their search business, where they have 90% share, going to remain high? Probably not. But they have other businesses as well, which we're intrigued with, which are fast growing. They put in a $70 billion buyback. $70 billion buyback. That's a lot of money. They have more cash than debt. And they've got, hey, they're smart.
All right.
A bunch of smart dudes. So again, be careful. Not that these aren't terrific companies. Be careful. The price sets up your return. The price you pay for the asset sets up your return.
Yeah, it's easy to buy. It's not always easy to buy. It's sometimes buying at the right price helps set up your exit and what you're going to get out. It matters a lot. So if you take a look over the next 5 to 10 years, which is much like today, driving into work, very foggy, hard to predict, what are some of the bigger ideas or bigger opportunities that you're excited about?
What a softball. I love that question. Thank you. Thank you, Joe. So I'm going to flip to my love, and it has been for when I first started to invest, so that goes back 60-some years, and that is smaller companies. What's happened over the past many decades, Small used to be, when we started the fund in '84, small used to be, micro cap was considered anything under $100 million in value, meaning if a company had sold for $10 and had, let's say, 10 million shares outstanding, it would be considered 10 times 10, $100 million market cap. Small was under 500 million. Today, that definition has gone up to 7 billion. 7 billion. I think investors have lost sight of the companies that are in that 7, 6, 5, 4, 3, 2, $1 billion market value, right? That's price times shares, real easy. This is a graph looking back over time, and you can see that the price to earnings ratio for small, which has grown from 100 or 200 or 300 million to now 7 billion, seems to be on the bargain counter. It's really happened only 4 times in the past 40 years. We've been in an extended period here of late, but you can find industry leaders at remarkable valuations. We're very fortunate. One of the big winners for the value fund over the years has been in the debt collection area. We bought our first investment in that area was a company that was a leading debt collector. It had no debt, and it was selling below cash. You could buy the business below cash per share. There are businesses in the marketplace today that are selling below cash today. They're in the microcap area. However, there's a debt collector today, which is America's leading debt collector. We're talking about billions now. It has a market value of about $1 billion, and they're selling about 6 times, 7 times earnings. 6 times earnings is 16% on your money, after tax. We think that's a marvelous investment. We'll see if it pans out. The insiders, both the CEO, the chairman of the board, and the CFO bought $3.1 million worth of stock at this price. So we're in good company. We'll see if it works out. But this is an amazing opportunity. You don't have to go to foreign markets. Foreign markets, are, as he indicated, are 14.5 times. The U.S. small cap market, as measured by the Russell 2000 value, is selling at 12.5 times. That's 8% on your money if you bought the entire group. Our fund is selling at about 12 times earnings. We'll see if those earnings materialize. But again, 12 times is 8% on your money.
Yeah.
A good price.
Very attractive, no doubt. I want to be sensitive to the time and the audience questions that we might have. I have a couple more questions we can get to, but I'd like to get to the audience if you're okay with that. Did you have any other slides you wanted to cover?
No, go ahead.
Okay. So I know we have some mics out in the audience. If anybody has any questions for Bill, please raise your hand and we'll make sure to come around to you. I'm sorry, but the lights are kind of bright. I can't see all that well. We're just knocking them dead. They don't have any questions. So I do have a couple more, and if anybody does have a question, just find a mic and we'll. We got one right over here.
Hey, Bill. Bill Preby. I too raised my hand. One of the last men standing, having been in this business since the '60s. Now we're talking about AI, cryptocurrency, meme stocks. What do you, how do you respond to those who say, you're old, you're past your prime, this time it's different?
Well, I guess I've used that. and perhaps it is to some degree in terms of valuing tech companies. Graham would have a difficulty in doing so because with his traditional valuation metrics, most technology companies have little shareholder equity. They have little, meaning book value. So that metric is not appropriate. I think there are ways to participate. Let's just talk about Bitcoin. Perhaps there are financial entities which are profitable, well-run, which are involved in the crypto market. Again, in some cases, they're selling at less than 10 times earnings. and they're large institutions. So that's a way that we've approached it. The tech area is tough for us because of the huge multiples that people are willing to pay for companies that really aren't making any money at the moment. So we've avoided those. And perhaps we've missed the boat in some cases, but we'd prefer to stick to our knitting and stick to our investment philosophy.
Great. All right, well, if anybody, oh, we've got one more back here.
Hi, Bill. Rodney Hathaway here.
Oh, Rodney.
Good to see you up there. Over the years, you've been at times more active as an investor in some of your companies. Couple occasions doing 13D type filings. Do you feel in today's environment as an advisor and owning some of these small and microcap stocks, do you find that activist shareholder is a component of what you do in the investing process still?
Thank you. Well, Graham was quite clear on this. Again, going back to if you buy shares in a company, you are an owner rather than just selling the stock and moving on. If you're uncomfortable with something that's happened, perhaps voice your opinion. So he was a bit of an activist, meaning an active shareholder. He's going to attend their annual meetings and speak out. I see nothing wrong with doing that. We can make suggestions. I think we have one 13D filed as of today where we own over 5%. But typically, we try to find companies where there's managements are aligned with the public shareholders and they don't need an activist component. But hey, if they're thinking of doing something stupid, we might voice our opinion.
Makes sense. So one of the things I've always liked to do with our audience is, or with our keynote, because of your years of experience and your perspective on things, we've got a fair number of young people in the audience. What would you share with somebody who's coming up in the investment world today around just how they should be thinking, how they should be preparing themselves, and how they should be continually learning so that they can stay relevant as time goes on?
Well, for sure, find a good mentor, someone who is willing to work with you and help out, who's perhaps seen the extremes of fear and greed. I think we've gone through something close to 12 bear markets. So whatever field you're interested in, find a great mentor and work with them.
So one of the other questions I wanted to ask you is, what's one thing that you think people don't know about you that might surprise them?
Something about me?
Yeah.
Well,
gardening's off the table because that's already covered. So.
Right. I'd like to be a better golfer, that's for sure. Lloyd, do you give lessons? But time marches on. So, hey, I like to watch golf. How's that?
That's all right.
And pretend. Hey, I want to leave you with just a couple thoughts here. I think this is a marvelous opportunity for the individual investor to invest, perhaps using the escalator on the left when we came up today, not the one on the right, which was well-traveled, meaning there are companies in your backyard probably which are a bank, a local bank perhaps, which is paying a 4 or 5% dividend, trading at or below book value. When the S&P 500 is trading at 4 times book value or equity, you can buy good regional banks in your local community probably at book value or less. I think it's a marvelous area to be investing. And also, we're very keen on lower short-term interest rates. If you have money in a money market fund because of the yield, expect that to drop sharply over the next perhaps year as the Fed finally relents and cuts short-term rates. The 2-year is now well below the 10-year, indicating that rates are going lower. We have an inverted yield curve still, so short-term rates should drop precipitously. That's going to be very good for banks. It's also going to be very good for housing. We had a housing stock bought out today at about a 50% plus premium to where it was trading yesterday. The markets are still extremely inefficient in small cap land and micro cap land, and that's where the opportunity is. Most brokers, most analysts don't follow it because it doesn't generate enough volume for them to, support their research staff. But we think that's a great area to be looking at. So home builders, we just added another home builder today to fill a gap after one company's being bought out. But again, you can buy them below book value. Supposedly, there's a 4 million home shortage. These companies are well run by terrific teams and again, trading for possibly 6-7 times normalized earnings and well below book value. Fantastic opportunities. Those are two areas that I'd look at.
Yeah, can I just ask one more question around, a lot of discussion around indexing versus active management. And I'm just kind of curious how you address that when people ask you the question.
Well, I have a slide on that.
How did I
if
know
I can
that?
find it real quickly. This is pervasive passivity creates market inefficiencies, and that's what we're seeing today. So this goes back a number of years, and you can see this tremendous. The first ETF, for example, came out in 1993, the S&P 500. Now there are 3 giant S&P 500 funds which almost have $2 trillion in them. $2 trillion in the S&P, the big ones, principally dominated by those 10 top stocks. But in any case, you can see the amount of money that's moved from active investors, such as Heartland and others, Fiduciary Management, Bill Preby's firm, and others in this room, and moved into passivity. Hey, there's a place for it, but we think this sets up a tremendous opportunity for the enterprising investor, someone who is willing to, again, perhaps do their own work or hire someone who does that work for them and invest in the areas less traveled. So I think Graham would be licking his chops saying, gee, there's a tremendous amount of value here in this market today.
Yeah, I mean, to some degree, the answer is, somebody says, should I index or should I use active management? The answer is yes, you should use active management and maybe index where it's appropriate. But there's a lot of opportunity, as you articulated, in that area of the market where it's really, really inefficient.
Right.
Well, thank you. I got a couple of housekeeping things before we close, if you're okay with that. And just I'll peek around if anybody has one last question for Bill before we close. But before we close, we have a special sponsor that we'd like to thank. Our friends at Heck Capital have an instrumental connection to a major supporter of the organization. Their gifts over the last 3 years have been an absolute game changer in supporting our programs. As a result of that, thousands of teens have been served because of the Heck leaders in this connection, and we wanted to thank Heck Capital. I also want to tell you about an exciting opportunity. The Wisconsin Financial Literacy Foundation is a longtime partner and supporter of Secure Futures. This group clearly shares our passion for financial capability, and we are very excited that they're going to once again donate the proceeds of their annual golf outing, which takes place on July 28th. Many of you here I know have participated in the golf outing. They do a terrific job. It's a lot of fun. Not only will you get to golf at the beautiful North Hills Country Club, but you'll be able to spend the day with a terrific group of people, and you'll be helping us empower more teens with our financial education and mentorship programs. You can scan the QR code from the screen to register. I think they're bringing it up right there. And finally, one last thank you to Bill, Nick, Janet, Evan, and all of our sponsors. Please, all of you, take a minute to complete your green survey program and be sure to include your contact info so we can keep you up to date on the 2026 plans. And please save the date for May 5th of 2026. Same place, same time. We're going to be here for next year's conference. We want to once again thank everybody for coming. I'd like to invite you to exit out the side doors after we thank Bill for the networking event sponsored by Godfrey and Kahn. So Bill, thank you so much. What a treat to be able to spend this time with you, and hopefully we'll get a chance to visit.
It's been a pleasure.
Thanks so much.
Thank you. Thank you.